everyone. Welcome and thank you for joining today's PENTalk. I'm Beth Parker with Pentegra. Just a few housekeeping notes. If you have any questions during the presentation, feel free to put them in the box at the end of the webinar. We'll answer as many questions as time allows. Tomorrow, you'll receive an email with a link to replay today's broadcast. Joining us today is Rich Rouser, Senior Vice President of Thought Leadership and Practice Management at Pentegra. Rich has more than 30 years of experience in the retirement and benefits industry. He is responsible for helping to shape and define Pentegra's viewpoint on workplace retirement plans, plan design strategy, retirement success, and employee savings trends. Rich, thanks for hosting today. Let's see if we can make more sense of RMDs for the folks on the call.
Beth, thank you for the introduction. Thanks everybody for joining. We're going to keep today's PENTalk tight in terms of time, so we're going to shoot for no more than about 30 minutes on this one. So the IRS and Treasury just came out with, actually a couple of weeks ago, a preview of a notice, right, that they're going to publish in the Federal Register. Actually, it was supposed to be published yesterday in the Federal Register, clarifying what's going on with RMDs. So the notice is Notice 2022-23, and it's really reaffirming some previous guidance that they had put out with respect to RMDs. It talks about the 10-year distribution rule under the Secure Act, and it clarifies some of the confusion with respect to RMDs, required minimum distributions for 2021 and 2022. Most of you will recall that for 2020, the CARES Act precluded the need to take an RMD for 2020. So that little fact kind of maybe creates some additional confusion, because I know a lot of participants were maybe thinking they didn't have to do RMDs for 2021. So that kind of compounded things a little bit. So the notice in and of itself provides some relief for taxpayers that may not have taken an RMD for 2021 or 2022 because of some of the confusion that has been going on here. So just to kind of, and I'll get into this in more detail, obviously, in the next couple of slides here, but, we had RMD rules in place prior to the Secure Act, prior to passage of that, which was December 19th, 2019. So Secure Act amended how RMDs are calculated for certain distributions, not necessarily all of them, but for some of them. Then what happened is in February of this year, the IRS came out with some proposed regulations on RMDs, which I want to say kind of shocked a lot of practitioners in the industry, as well as participants or beneficiaries who are getting RMDs, because the interpretation of how that 10-year rule actually works is different from what most people expected, and different from, and we'll get into this, different from the 5-year rule that was in place under some of the prior laws. So this notice really is to clarify a couple of things. Also, to me, it's pretty clear that, I almost would have expected final regulations on RMDs, because they did proposed regulations back in February. But my take on it is they're probably going to delay that for a bunch of different reasons here. So we have a footnote on the material. These are obviously tax-related issues with respect to RMDs. Pentegra as an organization can't per se provide tax advice, but this is really a good overview of what this notice says, how the rules work today, and really we're going to focus on the notice, the points of the notice, the relief that's provided in the notice, some of the clarifications that are provided, and so on. So again, I think the initial confusion might have started with the Secure Act and how the 10-year distribution rule actually works. As I said a minute ago, 21 and 22 distributions, there was definitely some confusion for certain people who otherwise needed to take these RMDs. So again, this notice is clarifying a lot of what's going on with this. And again, it provides relief, which is terrific. And all of that stuff is good news. I guess the not so good news is it kind of makes it more confusing, right? And right now, because we're also used to how the rules used to work. And again, we'll go through some of the differences of how they actually work, or how they're intending to work when those final regulations are produced. And again, one thing this notice makes clear is that the final regulations, whenever they're issued, whether it is this year or probably sometime next year, it's intended to apply with distributions beginning in 2023. So it looks like they're putting off some of the hard and fast rule making, the need to abide by those new rules certainly for this year. Again, Secure Act changes for required minimums took effect in 2020. I mentioned the proposed regs issued earlier this year, and the notice literally published in the Federal Register should have been yesterday. I didn't see it yet, but they're usually pretty good about publishing things on time. And again, the information we use to create this presentation is really from the advance notice that they produced not quite 2 weeks ago. So that's, and typically there's no change between that advance notice and what's actually published. The one thing that the preamble to the proposed regs that were published back in February said is that participants and beneficiaries should rely on existing RMD regulations, but also take into account a good faith interpretation of the Secure Act. And again, I think that's where one of the primary confusions comes into play, because there's definitely a difference in terms of how that 5-year distribution rule worked versus the new 10-year rule. So we're going to tear that apart during the discussion today. Section 401A9. Now, I just want to caution you, I've got a bunch of, whether it's code sections or whatever throughout this. I left them in because 401A9 might be familiar to some people here today. But it's really the code section that deals with required minimum distributions. I'll put some other code sites in here later, and we decided to leave them in because, believe it or not, it leads to some clarity in terms of how we kind of tell the story of what they're doing here. So let's get into some of the rules. The rules always have set forth something called an RBD, which is the required beginning date for distributions. And the rules have always defined the period of time over which, that participant's plan assets, or IRA assets for that matter, must be distributed. So basically what the rule says is, and again, this is a little bit of a rehash of the rules prior to Secure Act, right? But essentially the entire interest of the employee in a qualified plan, typically we're talking about defined contribution plans here, has to be distributed beginning not later than the employee's required beginning date. So I'm not going to go over all the really fine points, the fact that, if this year is a required distribution year and it's your very first year, you really have until April 1 of next year. So I'm not going to go over all of those basics. I'm going to really try to highlight the differences that are coming into play. So, and the required beginning date kind of kicks off distributions over the life of the employee, or the participant, or the beneficiary for that matter, or it has to be over the lives of the employees and a designated beneficiary. And again, they put some gobbledygook in here, over a period not extending beyond the life expectancy of the employee and the designated beneficiary. So essentially, those are some of the joint life rules that come into play in terms of how you calculate the required minimums. So with that said, we're going to keep on with some of the additional background information here. So one aspect of this is the employee dies after the required minimums have begun. The rules say the employee's remaining interest has to come out at least as rapidly as under the distribution method used by that employee as of the date of the employee's death. Let me try to get to the next. Bullet. Yep. And then in the alternative, if the employee dies before the required minimums have begun, there's kind of two different ways it can kind of come out. And again, this is the old 5-year rule. It has to come out within 5 years after the death of the employee, or over the life expectancy, again, of the employee and the designated beneficiary. And again, those distributions were to begin no later than 1 year right after the date of the employee's death. And again, you can see the bullet point here. There's an exception for how it's done if there's a designated beneficiary who's the participant's surviving spouse. And again, that difference in the calculation methodology really has always been there. So nothing new so far. So here we're going to talk about this section 401A9H that was added by the Secure Act, and we'll go through each of the aspects here. So basically, there was a new 10-year rule, again under 401A9, which is just the code section, speaking about required minimum distributions. So they added a new section. And essentially, this means that a participant or an employee in a defined contribution plan, if they have a designated beneficiary, right, if they name someone, the 5-year period under that old 5-year rule is simply, I want to say simply for this point, stretched to 10 years. So it becomes a 10-year rule, regardless of whether the employee dies before that required beginning date. So far it doesn't sound like there's too much of a difference except for the extension, but there is, and we're building towards that. So the exception to the 10-year rule, which essentially means that 10-year rule is treated as being satisfied if those distributions are paid over the lifetime expectancy of that participant and that beneficiary. Applies only if, you can see I have highlighted in blue, if there's an eligible designated beneficiary. And I left the code section in here because they, throughout this notice, they hit us with a lot of code sections, but we'll end up defining those as we go along. And I left them in there so it's easy to kind of correlate, their actual language in the notice to, what's actually happening and what does that mean in plain English terms. So eligible, let's define the eligible designated beneficiary. So number one, it could be a surviving spouse. Number two, it could be a disabled individual who's not necessarily a spouse. It could be somebody who's chronically ill, right? Again, not necessarily a spouse. It could be a minor child. I'll point out we're going to come back to minor child because that's where the rules get complicated. And it gets a little bit complicated, I think, here for anyone other than that surviving spouse. And again, eligible designated beneficiary includes an individual who's not more than 10 years younger than the account owner. And the last, I think there's a last bullet point, certain trusts that were created specifically, right, for a disabled or chronically ill beneficiary. That's kind of included in the definition of an eligible, I keep stressing that word, eligible designated beneficiary, because that is, under this notice, technically different from just a quote-unquote plain old designated beneficiary. So with that said, let's continue. When that eligible designated beneficiary dies before the original participant or the original individual's plan account has been distributed, the beneficiary now, right, I'm now down to the third level, not just the participant, but the eligible, but the person beyond that eligible beneficiary, right? That beneficiary, the eligible beneficiary, is subject to a requirement that the remainder of that person's, the original person's assets or account be distributed within 10 years of that eligible designated beneficiary's death. So that's part of where the wrinkle comes in. By the way, one other wrinkle that has come in, I didn't mention it yet, is that RMDs were pushed from age 70.5 to age 72. So, in my mind, that increases kind of the murkiness of how this is going on, and you have to keep a couple of different moving variables, front and center when you're looking at these rules. And then they hit this with a minor child. So when a minor child reaches the age of majority, that child is no longer an eligible designated Benny. And at that point, they have to then make sure the rest of that account is distributed within 10 years of that date. So, you kind of have a moving target, right? If that child beneficiary, who for a portion of their time was deemed to be an eligible designated beneficiary, once they hit the age of majority, all of a sudden RMDs for that child would potentially have to go up, right? If that child initially, I'm going to make it up, was age 15 and they hit the age of majority and they were maybe taking out very small RMDs, all of a sudden the RMD amount could increase dramatically such that it all comes out over the remaining years up to 10 years after they hit the age of majority. Okay, so that's a wrinkle. So this section of the Secure Act applies to distributions for anybody who might have died after December 31, 2019. Doesn't apply, if somebody was already kind of annuitizing payments out of the plan, before December 20th. By the way, the key date there is, I believe the Secure Act was signed on December 19th. So they're kind of saying if this was in play before the Secure Act was passed, and those payments are exempt from these rules. And, the next bullet, as we kind of go through this, this provides that if an employee who participated in the plan died before that section became effective, the employee's beneficiary and that next beneficiary died after that date, then that designated beneficiary is treated as an eligible. Now, I have yellow highlighting here as the eligible designated beneficiary. So they become, they kind of change status for this purpose from a designated beneficiary to the eligible designated beneficiary. And it also, again, I mentioned this in the prior slide, that section applies to any beneficiary of that, right, designated beneficiary. So again, we're kind of going from the original participant to the designated beneficiary, who then could become the eligible designated beneficiary, and then to that subsequent beneficiary of that individual. So if that sounds clear, that's the way it lays out, right? And just a footnote on this page, if the plan from which these accounts are coming from is collectively bargained or governmental, there's later effective dates for all of this stuff, which I'm not going to go into at this juncture. Excise taxes, I think most of us know that there's an excise tax if you fail to take a required minimum distribution. That tax is 50% of the amount you could have, would have, should have taken. So we just want to put that out there as a kind of a placeholder as to what the penalty would be if you fail to do this properly. So again, as I mentioned earlier, IRS and Treasury did those proposed regulations back in February of this year. And they originally stated that these rules would apply hard and fast for 2022 distributions, RMD distributions, right? That was the original take. Again, that was way back in February, and arguably that should have been plenty of time to think about it, to deal with it, and so on and so forth. And again, the proposed regs did address the issues related to that new 10-year rule, which are different from how, in some ways, to how the 5-year rule worked. So again, the proposed regs laid it out this way. for an employee or participant, right, who dies on or after the required beginning date, distributions to that employee's beneficiaries for calendar years after the year of death have to satisfy, I call it the gobbledygook, right, the 401A9BI provision here. So we're going to get into what that means exactly. And the reason I left it here, it'll help correlate and flow through what they're actually talking about. It would have been way too many words to describe this little section here. And then, furthermore, right, distribution to that employee's beneficiaries must also satisfy a couple of other sections of code. And again, I left the gobbledygook there because, again, it'll help in the translation. So these are the requirements. And again, just looking at these words, it doesn't really tell you much of anything right now, right? But we're going to get into the meat of it right here. So in order to satisfy that first section, I just highlighted the BI portion of it, right? The beneficiary of that employee who dies after the employee's required beginning date must take an annual RMD, required minimum distribution, beginning, and I highlighted this, beginning in the first calendar year after the year of the employee's death. And the BI section, BII section, I should say here, in order to satisfy that, the remaining account has to be distributed by the 10th calendar year after the employee's death. And again, subject to an exception, which we'll kind of get to. So in order to satisfy both of those requirements, so for in a situation where the employee dies after the RMD, after the required beginning date, with a beneficiary who's not ineligible. This first time I think I said they're not an eligible designated beneficiary. The annual RMDs must continue to be taken after the death of the employee, with a full distribution required by the end of the 10th calendar year, right, following the year of the employee's death. So a lot of this is newer, and this is what's led to the confusion. So now we're going to switch back to the case of a designated beneficiary who's an eligible designated beneficiary, right? That's that list of 7 or 8, the spouse and the terminally ill individual or disabled individual, right? Those listing of people who can be deemed to be an eligible designated beneficiary. So let me just read this section again. The eligible designated beneficiary includes an alternative to the 10-year rule, right? And essentially annual lifetime income or life expectancy payments could be made to the beneficiary beginning of the year following the employee's death. So under the proposed regs, and again, this is where we're potentially seeing changes here. If that EDB, eligible designated beneficiary, is using that life expectancy method, then the eligible beneficiary must continue to take those distributions after death, again, with a full distribution no later than the 10th year after that employee's death. And again, there's a similar treatment for the child, the minor that I mentioned earlier. It kind of switches for that child, potentially from something that could have been over some life expectancy to all of a sudden accelerating when they hit the age of majority, to require the balance of those payments to come out after the 10-year period. So let me keep going here. So again, the IRS and Treasury, they always leave approximately 90 days for a comment period when proposed regulations are issued. And there are a whole bunch of comments out there from owners of inherited assets, inherited qualified plan assets, indicating that they thought that new 10-year rule would apply differently than what's in the proposed regs, right? And maybe they thought it was going to be similar to the old 5-year rule. And again, I'm not going to go into the minutia of everything there, but essentially the key component was that there would not be any required minimum distribution due for a calendar year until the last year of that 5-year or the new 10-year rule. So, under the old rules, somebody in this category who was a beneficiary could have said, okay, I inherited the account, the original participant died, but I don't really have to do anything for the first 4 years of that. I could just wait till the 5th year. And you might say, well, a lot of people may think that makes a heck of a lot of sense because, you can continue to compound the assets on a tax-deferred basis. So they thought they could kind of wait until the end of that 5-year period. But again, they believed it was now they could wait till the end of the 10-year period, which is the exact reason that many people didn't take that RMD, if they were in this category, didn't take that RMD for 2021 and maybe haven't taken it yet in 2022. So that is, I think, really the crux of the issue here. A, the change in the time frame, and B, the fact that most folks thought it would be treated the same way as the old 5-year rule. So again, this is the exact point. They probably didn't take a distribution in 2020. Well, put it this way, proposed regs weren't out until 2022. So I could certainly see how there'd be confusion with 2021. And those proposed regs came out in February, and many people have not acted on them for to this point in time. And but for the fact that the IRS came out with this notice, they might have continued to believe that they could do it kind of the old way and just wait till the end of that 10-year period. So I mentioned this bullet earlier. They've said in this notice that the new final, whenever they come out with final rules on this, and again, I'm kind of thinking it's probably not going to be this year, but I'm hoping it's going to be in the earlier part of next year. Full force of the new rules wouldn't be in play until 2023. So what does that mean? It means they're providing some guidance for 2 categories of affected parties, right? The first one is if there's a defined contribution plan that failed to make that RMD, is not going to be treated as having failed 401A9, which is the RMD rules, merely because it didn't make the distribution. So that's the good news, right? Because that technically would be an operational defect of the plan, and that would take some unwinding if the IRS and Treasury were hard and fast on enforcing their position on it. The second category is the individual affected taxpayers. Never mind the plan. Gee, what about the taxpayer? So the IRS has said they're not going to assert the excise tax due under 4974, which we talked about in one of the early slides. And furthermore, if that taxpayer has already paid an excise tax for missing an RMD in 2021, the taxpayer can request a refund of that excise tax. I know we're getting tight on time. We're going to get through a couple of more slides. I'm not sure how many questions we can take, but let's go into just a couple of other fine points. As specified, and emphasize the word specified RMD is any distribution that's required, that would otherwise have been required to be made in 2021 or 2022 from that plan, DC plan or IRA. If it was required to be made if that participant died. Okay, so we're going to get through. I know I'm going fast here. It'd be required to be made to the designated beneficiary of an employee under the plan if the employee died in those couple of years, and on or after, right, died in 2021, and on or after the employee's required beginning date, and that designated beneficiary was not taking lifetime benefits. And again, this is where it gets complicated, right? Or if the beneficiary of that eligible designated beneficiary, who's treated as, right, again, early on I said you got the participant, you've got the initial beneficiary who can become an eligible beneficiary, and then there's a third beneficiary who could also become that eligible designated beneficiary. So again, if these deaths are occurring, it kind of creates, I'm going to kind of skip to the chase a little bit, kind of creates a matrix of definitional terms here. So some of these terms are easy to figure out, and some of it's going to be a matter of just putting a tag, right, on the situation. Take a look at the participant first who owned the account. Take a look at that first beneficiary that was named. Are they an eligible designated beneficiary, yes or no? If the answer is yes, and if they've named yet another third beneficiary, if you will, in this matrix, that person can, I'm going to say, be temporarily be deemed to be an eligible designated beneficiary, which kind of gets overridden in that example of that point where that child, in that other example we went over, it reaches the age of majority. All of a sudden, they're not an eligible designated beneficiary. So a lot here. We tried to make this simple. The notice wasn't all that too terribly simple. So the bottom line is, look, it's good news that they took the comments from the proposed regs seriously. It's crystal clear to us that a lot of people pretty much thought the new 10-year rule would work like the old 5-year rule. And because of that, they failed to take RMDs, and for that matter, certain plans might have failed to make those RMDs for this year and last year. So they're providing relief. That's the good news. The bad news side of this, and I alluded to this earlier, is that the final regs are probably going to be further delayed and might be delayed even more if Secure 2.0 is passed later this year, because there's potentially some other changes coming in that body of proposed legislation that would impact RMDs. So again, final rules really wouldn't come into play until 2023. And I just hope that, honestly, look, that the final regulations provide service providers, right, whether it's a record keeper or a third-party administrator doing the work on the defined contribution plan, or the custodian for that matter of an IRA. I hope there's enough time to, quote unquote, reprogram systems to tag and to identify some of the new definitional terms that they've thrown out here, right? This, in particular, this eligible designated beneficiary, right? And I don't know, that may involve those service provider updating various forms that they use to collect the information so they can calculate these things. Again, in my experience, most service providers in this industry are doing those calculations for participants, but as you can see from this notice and from the proposed regs that they issued, there is definitely confusion, right? The 10-year rule is not as simple as assuming, you can't assume it's the same as the old 5-year rule, because it's not. They have new definitional terms that have to be accounted for. And again, all we ask for in the industry is time to be able to program systems to kind of make this easy for plan sponsors and for the taxpayers who are impacted by this. That's really the critical thing, because in my view, right, quite honestly, if everybody who's eligible, or I shouldn't say eligible, and anybody who's required to take an RMD as a beneficiary, it would be very complicated if each of them had to reach out to a tax advisor or accountant to, decipher their specific situation. So again, we're hoping the IRS comes out with updated rules, final rules, pretty quickly. Beth, I don't know if we have time for questions. I'll leave it to you, though.
Okay, Rich. We are over our time, so we'll go ahead and end it. But if you did submit a question, we'll definitely follow up with you today, tomorrow time frame, get that answered. So thank you, Rich, for hosting today. Thank you, everyone, for attending. Have a great rest of the day.
Thank you, everyone.